Welcome to the Income Cycles podcast, the place to discover how to get returns like the professionals as an average person in the property, forex, and crypto markets. And now over to your host, Mark Vernham.
Hello everyone, my name's Mark Vernham and welcome along to this edition of the Income Cycles podcast. This week we're going to be talking about the inflation cycle. Will it continue? How long and how it affects your income, and most importantly, how to profit from it. We're also going to be looking at what caught the news this week and caught my attention. And we're going to do a deep in-brief into the whole income cycles and inflation this week. And of course, we've got the income extra resource right at the end, so something to give you a real boost to get you going. So, on to the news this week. And I don't know about you, but I think it's been another interesting week in the world of income and finance and cycles out there in the market. And what's certainly caught my attention in the property side is this constant sort of slowdown of the market. And when I mean slowdown, yes, we're seeing prices in resale property slow. And I've certainly seen, if you go on Rightmove and start looking at, some of the prices that I'm seeing there, you're seeing reductions of pricing. And as soon as there's reductions, that means the market's either been overpriced and therefore houses are not selling, or people are starting to get desperate to sell, and that's why they're reducing their property prices. So, if you're looking to buy property right now, I still think there's a bit more in the market to go. But the leading indicator to what really goes on in the property market is the new build segment. And certainly the new build segment this week, we've seen demand for new homes, according to Zoopla, is down 50% on last year. So last year was, quite a good year at the start, but as we know, with the mini budget and everything that happened there, really tailed off and the whole sort of market got frozen, and then it went into the Christmas period. Well, that obviously really affected it. And of course, reporting always is a couple of months behind when it comes to economic data like this. But ultimately, we're seeing month-on-month decline and down 50% on last year, according to Zoopla. So essentially, this is even below the pre-pandemic levels. So we're still not seeing it recover above there. So once kind of pandemic hit, everyone wanted to buy homes and every home was being snapped up. Now it's starting to really slow. Also, the number of mortgage products on the market, before, mini budget was over 3,500, about 3,800. We saw that drop down to about 1,400 and then pick back up slowly, but we're still only at 3,600 odd of mortgage products. And they're only lasting around sort of 14 to 17 days in some cases. So really showing that the new build market is in trouble. So, that's really a good indicator that if the new build's in trouble, we're seeing reductions on resale prices, that I think we're going to see a correction slowly over this year with retail prices of property and what's going on there, but also new builds and trade prices of property as well. So all in all, I think the property cycle and the 18-year property cycle, we'll know more about that. We've got a foundation series podcast on that, so check that out in the podcast feed. But ultimately, this 18-year property cycle that we're in, is kind of moving around, and it's certainly heading towards a period where I think we're going to see some big declines, maybe 15 to 30% in some regionalised places over the next 12 months. But we'll wait and see. I quite openly admit sometimes that you can get this epically wrong, as we have done and some people have done in the past. So don't hold me to anything, but that's my opinion based on what I'm seeing out there and what's happening there, and property kind of being valued in the way it is. Over to the FX markets this week, and what we're seeing is the dollar index measuring the currency against a basket of other currencies. Basically has fallen about 10.7% since September, according to a report out there, which basically is the fastest rate decline since 2009, which is, quite some time ago. If we look back in FX markets and business markets and the markets generally, we're seeing a big decline there. And the dollar index basically measuring against other markets out there. For so long in the last sort of 18 months, it's been strong because of the constant money printing, putting it in there. But what we're now saying is obviously the Fed and the US government having a bit of a battle against each other here, because the Fed obviously want to kind of get inflation under control, as is every central bank does kind of out there. But obviously, if you don't know already, they're not the same party. They're not, they're two completely different elements, the government and the central banks of each country, and 9 out of 10 times they've got kind of not the same agenda. So we're seeing that the government, in this case the Fed, are wanting to bring down inflation, and the government want to kind of obviously bring down inflation as well, but they still want to continue making sure they can get growth. And certainly in the UK, US, there's always a political theme of obviously getting elected, so that's kind of coming up in the next couple of years, which keeps things really interesting about there. But the key thing is that the dollar is starting to weaken a bit more now. We're starting to see that, so that's a sure sign that there's trouble a brew, so to speak, in the markets. And obviously the ongoing things like the Ukraine war, obviously the gas supplies coming out of Russia, etc., being strictly limited. At the moment, oil prices are very low, but again, this is because we're trying to talk ourselves into a recession here, and that may or may not happen. Whether it happens at all worldwide or in certain countries. Certainly in the UK, they're trying to address this by talking themselves into a recession, saying we are in a recession, and that's really the key thing. And I saw literally a report last week that came out about when the data got released for income last year and what went on last month. Certainly at the back end of last year, the World Cup drinkers kind of saved us going into recession. So if you like a beer and you watched the football last year in the UK, you stopped the UK going into recession in that final quarter, as the reports only just come out, obviously for the back end of last year. But I think January has got off to a slow start for the markets generally. We're seeing trading activity very, very slow. Lots of minimal pip movements across the basket of tradings that we're doing. Dollar is not kind of moving. Gold is really the only thing that's moved significantly in the last kind of month or so, but certainly January was very, very slow to get back to work for the markets. And I think just generally we're going to see some tough times in kind of US 30, FTSE 100, those types of business related markets, as the squeeze of the cost of living bites and people are buying less goods and services, let alone the costs that the actual retailer or manufacturer are having to deal with higher oil prices coming down the tubes kind of thing because of the lack of availability out there. It's cheap now, but it's going to start to peak again. And we've not actually had really, I think, the full winter yet. We're in January, we've still got kind of February, which normally is the coldest month. So we're going to start seeing, I think, oil prices peak a lot more as demand really starts to kick in. And because Russia produces pretty much 50%, if they took all that of the gas and oil off the markets, then we're really going to start to see that bite even harder in oil prices. So oil and gas prices coming back down, but certainly high, and the FX markets just generally are slow starting for January and certainly for this week. On to crypto, which kind of is like the basket case of the world. It moves around all over the place. Things can change day and night, and you never really know what's going to happen with crypto. So ultimately, any other commodity or equity, if we saw that move around 20% in a day, all hell would break loose. But crypto, it seems quite normal for 20% Bitcoin to go up one day and then drop back down the next, or whatever it may be. So we've seen that. But something that came out of basically into the block data for January kind of shows that 59% of Bitcoin holders are profitable as the coin trades above the current realized price. So what it basically means is, from that, it's interesting data to say that, I'm not saying necessarily no one can predict this, but there's a cycle of adoption with new technologies. And again, if you want a fundamental understanding and look at that and how that works and how a cycle is out there, and I call it the mass adoption cycle for crypto, check out the Foundation series and podcast for that. You'll find a link in the show notes. But also, what it means is that 59% of Bitcoin holders right now, so let's call it simple, 60% nearly of people who currently have Bitcoin have bought below or on the threshold of the current price. So ultimately, they're going to benefit as it moves up, okay? So that means 40% of people called it completely wrong, okay? But I think ultimately, it's what we're seeing now is Bitcoin was being sold as a haven, a bit like gold was, as against the markets and what's going on there. But we're starting to see it move around all over the place again. It's starting to get some traction back after the crypto winter that happened last year. We're seeing the end of that now. It's starting to thaw and move around a little bit, but it's no longer kind of this entity that stands on its own. It's very much starting to get more and more intertwined. And I don't believe we're going to see some really big numbers again until we start to get a bit more mass adoption and a lot less of the FX exchanges going under, people being allegedly charged with criminality and things like that. I take my 2 cents whether or not ultimately that is just pure mismanagement of a company in a legal sense, and just stupidity in running a company that way when it comes to the whole FX stuff going down in the recent ones that we've had. We've had 2 or 3 of them. So you just got to look at this stuff and go, is it engineered by the news? or the politics or the governments out there to push people away from Bitcoin, or is it something that genuinely has been a scam and mismanaged, etc.? I'll let you decide on that. But the key thing is that, you could argue now we're starting to reach the bottom of Bitcoin pricing. I can't see it going much lower. If it was going to go much lower, it would continue to go lower. But I think we're starting to see that now, that's saying that, nearly 60% of the trades that happened in January are now at that same sort of point. So we're starting to see people get some confidence back into Bitcoin. But ultimately, it all really depends on what happens long term with Bitcoin. And like I say, 20% moves in a day, who knows what can happen. But there is a mass adoption cycle that we've done a pure analysis on to understand when potentially a crypto cycle can work and you can income benefit from it. So they're the things that caught my news this week. So let's now move on to this week's income cycles debrief, and we're going to talk a lot about inflation, which has really been, arguably the key word out there for the last year. And if you're in any form of investment at all, then you've got to be looking and understand inflation and how potentially it can affect it. Because ultimately there's an income cycle inflation to this. There is a cycle of inflation. And, when you look at the mass media, what you tend to find is that, they're all very bullish on, if it's high, we're going to get it low. If it's low, we're going to maintain it. And I think there's a mass manipulation on the inflation stuff. So what is inflation? Well, essentially, if you don't know already, it's a situation that means your money is worth less. If we just look at that's really what it is in this most basic sense. So any money you have now, if inflation is at 10%, it's worth 10% less a year. That's the key thing. So in a year's time, you come back to your account, you still got the same numbers in there, but the actual numbers and what they can buy, if we're at 10% inflation, is 10% less, okay? And you may know that already. That's a very simplistic term, okay? But obviously, for so long, and certainly for the last number of years, it's been very, very low. 2%, 3% at max, sometimes peaking above that and then back down again, then even lower. Now, why does this matter? Well, it matters because, like I say, if you've got any form of money in an account or in an investment or wherever it may be, then for this cycle, for you to work the cycle of understanding when inflation is and roughly how long it's going to last, and let's be clear, nobody or very few people in the world can call the markets and timing, and whether it be a crypto market, a property market, or an FX market, anything like that, to call it exactly when to get in and out. No one really is ever going to do that effectively, okay? All we're trying to do here is get you to understand and look at when is a good time to be moving around these different types of markets to benefit from it. And inflation really affects all of them. So that's why it's so important. So, if we look at the UK now, we're at sort of just over 10% when it was published this week. In the US, we're hovering around, I think, the 6% last time I looked at it. But ultimately, if we look at, say, the UK, they're saying it's like the Bank of England are saying we're at 10% now, and I'm going to just round it down for ease of discussion, but 10% now, and we expect it to be down at sort of 6 or even 4% within the year. Now, inflation can run away very, very quickly. If you ever want to look at resources out there, look at the Dutch bulb issue and Weimar Germany, where inflation suddenly can rocket away in a matter of hours sometimes, and loaves of bread costing thousands and thousands of whatever currencies out there. So you've got to be aware of this because it can run away very quickly. But it's kind of like a dog on a lead. Like once it runs away, it takes a lot longer to get it back than it did to run away. And that's the problem with inflation. Once it's out there, it's out there. It takes a long while to reel it back in, okay? And, what the Bank of England is saying, we'll get it down to 6%. Like, it's nigh on impossible. And the reason I say that is, they're sort of looking here. And if you look at the payback of long-term debt, okay, in the UK, when it comes to inflation, okay, the last time we had sub 10% was 1974. So when it went above 10%, 1974 was at 16%, okay? So 1974 was the last time we had double-digit inflation. What we then see is how long it stayed at double-digit before it got below that. It took till 1982 to get to 8.6%. So it went from 16 to 8.6% in 6 years. 6 years is how inflation took that long to come down from double digit. There was 1 year they moved the data around to suit them, and that was various reasons why I won't get into now, but it took 6 years. Yet they're saying they're going to halve it in, 6 to 9 to 10 months. It's just not going to happen, okay? So what this means is I think you're going to be looking in the UK, inflation around 8 to 9% this year. because of those factors, that it's just not going to be able to be pulled back in that quickly, no matter what they do. Obviously, we're talking into recession and various other things as well. And if you look at the US, the last time it was in double digits was 11.3% in 1979. Bigger economy, it moved a lot quicker, but it still took them 3 years, 1982, to get down to 6.2%. So you can see it takes a long time to move inflation down if it's done in the right way. Obviously, you can kind of destroy it very quickly, but it just causes untold damage out there in markets and everything. All the confidence goes. So Bank of England, US Treasury, etc., they're all going to try and hedge this down slowly, reel it back in slowly. But they're saying it's within a year, within 2 years. The reason that is obviously they're trying to support the narrative and government re-elections and stuff happening in whichever countries you're looking at. There's always something going on, so they've got to try and keep the people on side, otherwise the people revolt. And the governments want to support the Bank of England because most people don't know. Obviously, they're not connected; they're very much separate entities. So what I'm saying here is that ultimately, if you look at the US economy, it's likely to bring the yearly rate down to 3.2%, they're saying, by the end of this year. So again, they're looking to halve it. Like, where is this magic happening? Because it's just not going to happen. They're spinning a line, and then they'll come out at the end of the year probably and say, we didn't hit it, but at least we brought it down. I saw literally newspaper headlines this morning in the newspaper saying, in the UK, Bank of England declare we've got inflation kind of like under control, we're beating it. Now, they're beating it because they've gone from 10.6 down to 10.5. Now, if they're saying they're going to be at 6% by the end of the year, just do your maths. Like, it's just not going to happen. And like I say, historically, sort of 6 years in the UK, 3 years in the US is how long it takes to get there. So this is the key thing. And ultimately, the central banks are targeting 7.4% by the end of the year. So ultimately, it's still going to be high. It's a lot higher than what most of us have been used to for a number of years. Food in particular is much higher at 12.4. So it's not always an equal thing. But the key thing is, I just want you to be a bit more understanding of what's going on and what you're being told about these things to understand, most importantly, what's going on. And if we start to factor in things like higher oil and gas prices, higher raw material prices going up due to Ukraine war, we've just got China starting to reopen after its zero COVID policy, then essentially inflation is here to stay, okay? And it may be through the cost of goods and services that way as far as directly, or it's by manipulation of central banks, etc., to try and get it down. But double-digit kind of inflation in the UK is going to take a long while to get down to single digit, and in the US, like all these targets at both these banks, we just look at the two major economies, they're looking to halve them. It's just not going to happen in one calendar year, not in a sensible way. They could do it, but it would destroy economies overnight, kind of thing. So the key thing here is to understand this. So what you got to do is plan for this, okay? And now what does that mean? Ultimately, well, inflation affects the money. Wherever your money is, whether it be in a bank doing nothing, whether it be in a savings account doing something and earning you a small percentage of interest, whether it be tied up in property or bonds or stocks and shares, whatever your vehicle is currently, you've got to look at this and understand what's going on. Because if I said to you, give me 100,000 and I'll give you 5% a year, if you've been in savings for any amount of time in the last, say, 10 years, you go, that's amazing because I'm getting like 0.002% or whatever in the UK. Well, 5% sounds amazing, but here's the deal. If inflation is at, say, 9%, well, now your money is actually worth 9% less of a year. You're getting 5% back from the bank who's giving you a high interest and maybe locking it in. But the problem is you're still 4% down. So actually, imagine this. You go into your account, you log in a year's time, and that money is reduced by 4%. So instead of having 100 grand in there, you're now down to, 96,000. Even though the bank have given you 5%. I mean, it's crazy, isn't it? But most people don't see this. And inflation's kind of called the silent tax. That's really what it is. And I did a full presentation on inflation. If you want to know more about it, how it came about, how it's all developed, how it's measured, how it's tracked, etc. There's a full presentation on our YouTube channel, so feel free to check that out. Income Cycles, to search it on YouTube. And you'll see a full presentation on inflation that I did to a room back end of last year, where it gives you all the slides and everything, all the data points, everything you need to know about inflation. But the key thing here is that wherever your money is invested, wherever your money is located right now, it's got to be, and if you just pick wherever country you're in, let's just talk about the UK for a moment. So if I think, I've read the news and I believe what they're telling me, which is Bank of England are targeting 7.4% this year. I need to be earning 7.4% to stay still. Because otherwise, if I don't, every point that I'm off of that, I'm losing money in my account. Okay, now obviously you don't see that, but the earning power because of inflation, you're seeing it. Okay, and there's lots of other benefits to inflation from a debt point of view, which I'm not going to go into right now, but just getting and understanding the inflation cycle that we're in currently is going to last, based on data, 2 to 6 years, maybe 3 to 6 years if you want to be on that kind of simple terms. You've got to be at least earning 7%, even if they're going to hit their target. But when did the last time the Bank of England hit their inflation target? I tell you, virtually never, because they never hit the target. Look at the data. I think it was like 4 years ago, they declared 1 month they hit the target of inflation, okay? Same with the US Treasury, same thing. They never really hit the targets they claim. So why would you put faith in, A, understanding they're going to get to 7.4% in 1 year, which is a massive drop. Secondly, obviously, looking at it and going in the UK, right, 7.4, so from 10.6 to 7.4, well, that's it's a chunky drop. You just can't make that happen. Like I say, it's going to take time. That's the key message here. So you need to be in an investment, have your money working for you, okay, producing at least 7.4% if they hit their target in the UK. If they don't, well, you've got to hedge your bet kind of thing to go higher. So you want to be, arguably, if you want to be safe and making sure you're not losing money from your savings, your investments, etc. out there, you should be getting 10%, I would argue. 10% is kind of what I think you should be aiming for this year. And if you're not, and that's certainly what I'm doing now, I'm looking at all my investments to make sure I'm getting more than 10%. Now, for a lot of you might go, where on earth do I get 10% a year from? Like, Barclays, HSBC, any of the banks or whatever will only give me 5%. Well, there are other investments out there that are ability to earn 7% a month in some cases if you're willing to take a bit more of a risk on the money or whatever, and there's different ways around that. But the key thing is, ultimately, is like, I just want to make you aware here and think about this. Like, if you don't want your money to go down this time next year, and you want it to stay the same, but potentially go up and make you more money, which who doesn't, because you've worked hard for your money. You've got to get it making hard for you, work hard for you as it did you earn it. The key thing is you need something that's going to produce you 10% a year. So look at all your investments right now. Look at where your money's stored. Is it earning 10% a year? Because if it's not, you're losing money. You're losing money. Okay? If you're a US base, that might be a bit different. But just look at the inflation rate that's been published by your country and your central bank, wherever you are, and you'll see that they'll give you the target, they'll give you what it's currently at, they'll give you a target they're looking to get at just by a simple search online, and you can see what really number you've got to hit as an individual, because no one's looking after you here. You've got to take control of this yourself, so you don't get caught by this silent tax called inflation and the cycle that it's in currently, which is an expensive cycle. So we've got to hedge something against it to make sure that we're not losing here, okay? And then that way, if you get something that's basically going to give you 10 or 11% in the UK, then you're ahead of the game. You're making a bit of money, and if they do hit their target 7.4%, tremendous. You're now 3% up, okay? But there are vehicles out there, like I say, that can get you 2, 3, 4% a month, 7% a month if you want to be a little bit more risky. You can do various asset-backed investments, etc. as well. So that's the key thing here, okay? You've got to review your money to get the best rate possible to offset this cycle of inflation that we're in, which is going to last based on data, based on history, based on the cycle we have seen before, time and time again, anywhere between 3 and 6 years, okay? So make sure you're aware of this. Question where your money is. Phone up your financial advisors, etc., your professional advisors. Ask them where the money is and what it's doing, because this is really, really, really important. So take control of your inflation cycle. Make sure you're going to benefit from it, not get punished by it, which like a lot of people are. They're sitting there in silence whilst the money's being grabbed out of their account. Anywhere from 10 to 6% every single year is going down. You don't need too many years for those to add up to really be kind of in a hole, and you woke up one day and you had money there and the value of that money has dramatically dropped. So that's the key thing. So take control of your inflation cycle. You understand now how long it's going to be based on some of the data. Go and check it out for yourself. Go and do your own due diligence. I'm not here to give you advice. I'm just giving you knowledge so you can go and take better decisions and ask better questions. So I hope you enjoyed that. I've now got a special income extra resource, so Income Cycles extra resource, and of course I'd be crazy not to give you something inflation-based, because obviously it's a very big subject, but also quite a simple one when you understand it, like I've just summarised in the debrief. So this Income Cycles extra resource this week is an inflation calculator. So basically you can just tap some numbers in and get an understanding of what it looks like in numbers, because, you know, percentages and stuff like that, for most people it's very difficult to kind of put a figure on that. But if you've got X amount of money and you type that in and you put in how much the inflation is, and it gives you how much money that's now worth less, that's a very simple number to look at. And I know it sounds obvious, but it is, you know, and it's a very emotional subject, money. So what you want to do is head on over to the Income Inflation Calculator. Okay, so Income Inflation Calculator. You'll find that at the link in the show notes at Calculator Soup. I'll give you the full link in the show notes. And literally you just punch numbers in, see what's going on there, put in the percentage rate of what your inflation is for where you're based. So if you're in UK, put in 10%, let's say. If you're in US, maybe put in 6 or 7. And then just put in, and it will see how long in 12 months time, how much money you've got, how much less it will be worth. Once you've got that, you can now work on real numbers of, okay, I've got, you know, 10,000 or 100,000 invested. It's now going to be worth this amount. I need to top that up with my investment to make sure that I'm getting it working harder for me. Okay, so check it out. It's a great resource. It's the inflation calculator over at Calculator Soup. Link is in the show notes, and that is a really useful tool to have a play around with and really get ahead on inflation. And like I say, if you really want some more, there's also another extra resource in the show notes of where I did a full presentation for about an hour and a half to a room back end of last year about inflation, how it works, how it's calculated, what it works, how it affects you, etc., etc. The whole video there that really kind of shows people what inflation is as well. So you got not one but two extra Income Cycles extra resources there. So that concludes today's show. Remember, your money should be working even if you're not, and also it should be working as hard as you did to get it. My name's Mark Vernon. Take care, and I'll see you next week on the Income Cycles podcast.
That concludes this edition of Income Cycles. Be sure to tune in each week to hear the best information on how to get income like the professionals do from property, forex and crypto markets. For more information, please register your free account at incomecycles.com. Once registered, you'll receive our free weekly research roundup email containing links to the very best free trainings, webinars and guides to making an income like the pros do from markets. If you haven't already, you can subscribe to Income Cycles on iTunes, Spotify, or your podcast platform of choice to have Income Cycles automatically delivered to your mobile device each week, free of charge. You can email questions for the program to ask at incomecycles.com, and we'll answer your questions on the air from time to time in our Ask Us segment. Income Cycles is presented for informational and entertainment purposes only. The information presented on Income Cycles should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Income Cycles are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Income Cycles, its producers, sponsors, and host Mark Vernon shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Income Cycles. If you enjoy listening to Income Cycles, why not share it with a friend or colleague? We thank you for your support.